Sole proprietorship, partnership, limited liability company, or corporation. If you're wondering how to choose a California business entity, this video is for you. A sole proprietorship forms when you start conducting business without forming a business entity with the state. Sole proprietorships are the simplest form of entity. They are relatively easy to establish and maintain. They typically require few, if any, state filings. They do not require corporate formalities like meetings and officers. Sole proprietors have complete control over their businesses. They do not report to partners, shareholders, or board members. Sole proprietorships do not have to pay California's $800 minimum franchise tax. And the owner can easily transfer a sole proprietorship's assets and goodwill, for example, to a child who wishes to continue the business. On the other hand, there are no limits to the owner's liability. They are personally responsible for everything related to the business. From the perspective of creditors, plaintiffs' attorneys, and taxing agencies, the sole proprietorship's assets are the assets of the owner and vice versa. Sole proprietors may have trouble establishing credibility with potential customers and lenders. And because a sole proprietorship can have only one owner, it cannot sell stock or otherwise raise capital and scale up. Like sole proprietorships, general partnerships spawn spontaneously. They spring into existence whenever two or more persons conduct business for profit. General partnerships are easy to establish and maintain. They typically require few, if any, state filings or corporate formalities. In fact, they are often formed unintentionally when people work together for profit. Partners can support one another, complement each other's strengths, and relieve one another of sole responsibility for the business. General partnerships do not have to pay California's $800 minimum franchise tax. Because taxes pass through to the partners, they escape the double taxation of corporations. On the other hand, the owners of general partnerships are completely liable for the entity's obligations and for each other's actions. The partnership may end if the partners disagree or if one quits, or dies or becomes incapacitated. Because the only owners are the partners, they cannot sell stock or raise large amounts of capital. A limited partnership has both general and limited partners. The general partners run the business. The limited partners do not. Limited partnerships are a great deal for the limited partners, who generally can lose no more than what they invested in the partnership. They share in profits and losses without having to be involved in management. That makes management simpler for the general partners who run the business. For most decisions, they need not consult with the limited partners. However, limited partnerships may not be a good deal for the general partners. General partners are completely liable for the entity's obligations and for each other's actions. Some tricks can limit that liability, for example, using a corporation as a general partner. Limited partners may not appreciate their lack of control and rights, and general partnerships must file with the state and pay the $800 minimum franchise tax. Professionals who work together can form limited liability partnerships. LLPs enable professionals to work together while isolating themselves from each other's liability. In California, architects, CPAs, engineers, land surveyors, and lawyers can form LLPs. While partners are liable for their own acts or the actions of individuals under their supervision, their personal assets may be protected from the claims based on wrongful acts of other partners and from the partnership's liabilities. Because only select professionals can be partners, LLPs are less flexible than corporations when it comes to admitting new stakeholders or transferring ownership interests when, for example, a partner retires or dies. LLPs must pay regular filing and registration fees to California and sometimes to their professional societies, and must pay the annual minimum franchise tax. Limited liability companies are a newer form of business entity that, well, limit the owner's liability. Members of an LLC are generally protected from the LLC's obligations if the members follow best business practices to avoid piercing the corporate veil. LLCs are incredibly flexible. They can issue various classes of ownership interest. They can be controlled however the owners determine in the operating agreement. And they can be taxed as disregarded entities, partnerships, C Corps, or S Corps. LLCs have few corporate formalities, such as meetings and officers and board of directors, making them easy to maintain. LLCs are great for holding investment properties. Limited liability means that if the LLC faces a lawsuit or financial liability, the owner's personal assets may be protected against the LLC's creditors. Only the assets of the business itself are at risk. This limited liability can be lost through piercing the corporate veil, which happens when owners fail to observe corporate formalities and distinguish their assets from business assets. Limited liability also will not protect personal assets from the owner's own misconduct. Unfortunately for business owners, California does not give LLCs charging order protection. On the other hand, the law governing LLCs is less certain, since they have been in California only since the early 1990s. Many smaller business owners find the franchise tax a bit high. It is due even in a year when the LLC loses money. Because California does not provide charging order protection, a member may be protected from the LLC's liabilities, but a member's interest in the LLC is not protected from the member's liabilities. A corporation or C Corp is an entity in which the owners, also called shareholders, are taxed separately from the business itself. Under state law, shareholders of a corporation are generally protected from liability for the corporation's obligations. The corporation is treated as a separate entity and is solely responsible for its own debts and obligations. Corporations are especially useful for businesses that wish to go public, raise large amounts of capital, and scale up. There is no limit on the number of shareholders, and shareholders can easily buy, sell, and transfer their ownership interests. However, C Corps require much time and expense to establish and maintain. Bylaws must be carefully drafted, a board of directors must be appointed, shareholder agreements must be precisely spelled out, and stock certificates must be issued. Corporate formalities must be strictly followed. For example, a board of directors must be maintained, regular meetings must be held, and annual reports must be prepared and distributed. Corporations are subject to enhanced supervision by state and federal regulatory agencies, including the U.S. Securities and Exchange Commission. A shareholder's creditors can reach the shareholder's entire interest in the C Corp, including rights to distribution and management, if any. For tax reasons, it is generally a bad idea to hold real property in a C Corp. The profits of C Corps are subject to double taxation. First, the C Corp pays state and federal taxes. In 2023, the federal corporate tax rate is 21%, and the California rate is 8.84%, for a total of 29.84%. Then the shareholders pay income tax on the dividends in their personal tax returns. An S Corp is not a distinct entity. It is an LLC or C Corp that elects to have income tax flow through the corporation and directly to the shareholder. In addition to the advantages of the underlying LLC or C Corp, an S Corp has certain tax advantages. First, the S Corp pays its owner a reasonable salary on which the owner pays self-employment tax. Above the reasonable salary, distributions are not subject to the 15.3% self-employment tax. An S Corp can save significant self-employment taxes for the small business owner who makes more than enough money to cover a reasonable salary. In addition to the disadvantages of the underlying LLC or C Corp, S Corps face numerous restrictions. They can have no more than 100 shareholders. Shareholders must be U.S. citizens or permanent residents. No more than 25% of the S Corp's income can come from passive activities. Business entities and trusts cannot be shareholders, and S Corps can issue only one class of shares. Did you choose the wrong entity for your business? If so, you may be able to change your business entity. This is easy for sole proprietorships, more complex for partnerships, LLCs, and corporations, but it often can be done. I'm Daniel Van Slyke, an attorney licensed in California, Texas, and Missouri. You can find me at iplanlaw.com.